Welcome to the TabTrader Academy. My name is Oliver and I'm going to be walking you through this series. Today, we're going to be diving into the world of cryptocurrency spot markets. Let's first define what the spot market is. On spot markets, financial assets such as commodities, cryptocurrencies, or stocks are traded with immediate delivery. Unlike derivatives markets such as futures, on spot markets, people exchange assets right away. The money and the purchased product are exchanged immediately, right at the moment that the buyer and the seller agree on a price. Just so you know, spot markets are sometimes referred to as cash or physical markets because assets are exchanged for cash rather than the promise for future payment. That also means that parties take direct delivery of the assets involved and are therefore exposed to their price movements. Now let's talk about what a spot price is. The spot price of an asset, and spot originally refers to an asset being traded on the spot, if you will, is the real live price that an asset is trading at. This is the price for which one can trade an asset immediately right there and then. And on liquid markets, sometimes the prices can change instantaneously as new orders come into the order book. There are two types of spot market: traditional centralized exchanges and over-the-counter or OTC exchanges. The difference between them is that on OTC exchanges, assets are exchanged directly between the two parties, whereas on traditional exchanges, those two parties exchange via a third party of some sort. Let's take a look at an example to make the whole process more obvious. Imagine an investor, Mr. Smith, who finds out that a famous fund is interested in buying a particular token, which we'll call token X. He decides to follow the fund's example and buy token X himself. Mr. Smith therefore opens his TabTrader app and uses Ethereum to purchase token X. Mr. Smith's Ethereum tokens are transferred to the seller immediately, and ownership of token X goes to Mr. Smith. To wrap up this episode, let's go over the pros and cons of the spot market. One of the advantages is a transparent environment. There are no hidden catches and everyone can see what's been going on and agree on trades right away. Spot contracts are much easier to execute than futures contracts and require less technical effort. Such a system is particularly advantageous for traders because they can easily find a price they like, because prices are changing all the time, but they are arranged sequentially. Since investors obtain their purchases immediately, which is a benefit in itself, there is less chance of delivery failure, and there are no minimum contract requirements. However, there are also some drawbacks to this arrangement. Sometimes spot markets command higher prices in return for the flexibility that they offer. It may also be harder to regulate these transactions, and if either party notices that something is off about the trade, it can be too late to do anything about it because the trade has already been finalized. One last thing, spot markets are also less flexible than traditional markets because both parties are expected to handle delivery of the assets on the spot. And that's it. Now you know what the spot market is and how they work in real life. If you have any questions left over though, don't forget to put them down in the comments below this video and we'll get right back to you. And on that note, don't forget to subscribe to our YouTube channel and follow us on social media, and the links to that are down below. And of course, if you haven't already done so, download the TabTrader app.